Lots of people dream about retiring early at 55 or 60. But how much money do you actually need to make it work? And what's the real difference between retiring at 55, 60, or getting to 66 in state pension age? See, most people have got no idea what these choices actually cost them. So in this video, we're going to cover the real numbers I think you need to know. First, I'll show you what a £30,000 annual income actually buys you, and I'm going to use that just for indicative purposes, and then I'll break down exactly how much your pension pot needs for each of those retirement ages. I'll also explain the bridge year strategy that makes early retirement possible. Plus, I'll show you the tax-free cash decision that changes everything. So again, for clarity, all figures are in today's money, ignoring inflation, and the numbers are simple. And by the end of the video, you'll know exactly how much you're going to need for each age. You'll be able to calculate if your pension pot can support your early retirement. And later on, I'll also share with you the biggest mistake people make when it comes to their retirement planning timing. So my name's Zach Hussain, and I run financialeducation.co.uk, and I've got over 25 years experience of helping people plan for their retirement. So why are we using £30,000 a year as our target income? Well, this sits just below the PLSA's moderate retirement standard of £31,700. So the PLSA, otherwise known as the Pension and Lifetime Savings Association, sets out standards of living through retirement, and that's the target that they came up with. Now, there's a whole argument to be had about whether those numbers are right or not, but again, for the purpose of this video, let's just work with that. But it's also, to a large extent, a realistic number for most people planning retirement, because this £30,000 gives you a comfortable lifestyle without being excessive or unrealistic. So typically you can afford one foreign holiday and some UK breaks. You've got money for eating out a couple of times a month, and you can maintain your home properly and cover any unexpected costs that you might get. £30,000 isn't extravagant, it's not penny pinching either. It covers your essentials plus some fun and flexibility in retirement. And in my experience talking to people that have retired, that they find this level gives them security without giving them constant money worries. And of course, your state pension will eventually contribute, using current numbers, about £12,000 a year. So that means your private pension needs to cover the remaining £18,000 only from state retirement age. And this is why retirement age makes a massive difference to your retirement planning. But what happens before your state pension kicks in at age 66? That's the critical question we need to answer for each of the retirement ages that we're now going to look at. Right then, so let's start with retiring at 55, which clearly sounds amazing. You stop working whilst you're still young and healthy enough to enjoy it. But the reality is, this choice creates the longest bridge period for you to fund. So from age 55 to age 66, that's 11 years before your state pension starts. And for some people, it's going to be beyond 66 as well. But again, for the purpose of this video, let's just keep the numbers quite straightforward. So for those 11 years, your pension pot needs to provide the full £30,000 annually. So that works out at £330,000 just to bridge those 11 years to state pension age. Now, again, just keep the numbers simple because you would normally get some growth in that period, but again, just going to keep the numbers quite straightforward to help it make it easy to understand. So now after age 66, your state pension kicks in, and that gives you around £12,000 a year. So you still need your private pension pot to provide the remaining £18,000, and that normally needs to last you around until about age 85. So using the safe 4% withdrawal rate, that equates to roughly £450,000 in your pot for the top-up stage. So that's what you need after state pension age. Add the bridge period, and you're looking at £780,000 as a minimum pension pot size. And that assumes everything goes perfectly with no unexpected costs or emergencies. But here's what most people miss about retiring this early, in my experience, and that is not recognizing that they're going to have fewer growth years from employer contributions and the growth that they'd get through their investments, and that's just because they stopped working full-time at age 55. So the reality is, you're not just spending from your pot, you're actually losing out on future investment growth. So the reality is, the real cost is even higher than these basic numbers suggest. And that's because you're accessing your pension years earlier and giving up years of contribution and growth. So retiring at 55 means acting before that window closes for you. And that's what the next slide is going to be about: timing and tax traps. Now, retiring at 60 cuts that bridge period significantly down to 6 years. You're giving yourself 5 extra years of earnings and pension growth. And you're reducing the gap before state pension starts paying out. So 6 years at £30,000 means £180,000 to bridge the state pension age. So that's £150,000 less than the 55 retirement bridge that we just covered. So you still need the same amount after age 66 for the remaining years, and that's got to see you through to about 85. What does that mean? Well, it means that your total pot needs to be roughly 630,000 instead of 780,000, which you had at age 55. So that's £150,000 difference just by waiting 5 more years to retire. And those 5 years let your pension keep growing with contributions and investment returns. So in my experience, speaking to people that are thinking about early retirement or have early retired, many find 60 to be the sweet spot because you're still young enough to enjoy active retirement and enjoy travel opportunities, but you haven't created an impossible large funding gap to bridge. And there's another advantage most people don't think about with 60, and that is you can access pension savings from age 55, but it doesn't mean you have to take everything. So you could just work part-time from 55 to 60 and just take a smaller amount of money out. And this bridges you gently without triggering big tax bills or problems. And we've done some other videos on some of the issues related to tax when it comes to retiring and working at the same time. So actually the reality is 60 gives you flexibility around planned state pension age increases. The state pension age is due to rise to 67 under 2026 and up to potentially 2028. So your bridge might be 6 or 7 years depending exactly when you were born, but it's still way shorter than retiring at 55 requires. Moving on to the next slide, let's look at what waiting till 66 does to these numbers. So waiting until age 66 completely eliminates this bridge period altogether. Your state pension starts from the same year you retire from work completely. So this changes the entire calculation and planning approach that you need. You don't need £330,000 or £180,000 to bridge any gap. That from day one of retirement, you're going to get around £12,000 a year from your state pension. So your private pension only needs to provide the remaining £18,000 as the annual top up. So if you do live to 85, that's 19 years needing £18,000 each year. So using the 4% withdrawal rate, you need roughly £450,000 in your pension pot. So that's about £330,000 less than retiring at 55 needs in total terms. Now, some people can't wait until 65 because of health or job situations, and that's understandable. But if you can work until 66, it dramatically reduces your financial pressure. You need a much smaller pension pot to achieve a similar type of lifestyle. And there's also another benefit that people often overlook about working longer. Every year, working means national insurance credits continue building up. So worth adding here as well, if you do retire at 55, you may not have enough time to accrue the 35 years that you need to get the 35 years of national insurance payments to get the full state pension. So it is something you do need to look at. But waiting till 66 isn't right for everyone, despite the numbers. You know, if your health is poor or your job is physically demanding, it does matter when you retire, because quality of life in your 50s and 60s has a value to it too. So this, for me, becomes a personal choice and not just a clean financial calculation that's just done in the cold light of day. The key is understanding exactly what each choice costs you financially. And once you've done that, you'll be able to make a decision on where you think you should land with regards to when you should retire. Now, here's where most people make a critical mistake, I find, with their planning. They assume taking the full 25% tax-free cash immediately is the best thing to do, but it often isn't. That decision affects everything else about your retirement income completely. So you can take up to 25% of your pot tax-free. On a £630,000 pot, that's £157,500 as a lump sum option. And the remaining £472,500 then provide your ongoing retirement income going forward. But taking that full lump sum immediately has serious downsides to consider. The £157,500 sitting in the bank account earns taxable interest only. Meanwhile, it's not invested in your pension, growing tax-free anymore. So you lose years of potential growth on that money. A better strategy, and one that I often recommend to people, is taking tax-free cash in smaller chunks and do it gradually. You move money into drawdown and take 25% of that amount as tax-free cash each time. So this keeps your money invested for longer and allows it to grow within a tax-efficient wrapper. You also get more total tax-free cash over your retirement lifetime as well. So here's how the numbers work with the phased approach in practice. So you take £40,000 from your pot and £10,000 is tax-free cash. The remaining £30,000 goes to draw down for future withdrawals when you need them. So your other £590,000 stays invested, growing tax-free for now until it's needed. So actually, the phased approach gives you better long-term outcomes. And that is because you're not sitting on a big lump sum losing value to inflation. You're giving it a chance to grow because your money keeps working for you inside that pension's tax-free wrapper. And you maintain more flexibility to adjust as your needs change. And this is especially important if you're bridging from 55 to 60. So don't just automatically assume I'm going to get to 55 and take out the 25% tax-free cash, because that is probably going to be the wrong thing to do unless you've got a very specific need for that cash. So moving on to next steps, what do you now do with all this information? Well, firstly, work out which retirement age actually suits your personal situation the best. Don't just take 55 because it sounds nice without checking affordability. Calculate your current pension pot value across all your workplace pensions. Make sure you add up everything that you've got saved up so you know what the total amounts are. And then project forward to your planned retirement age using some growth assumptions. So you can use 4 or 5% annual growth as a reasonable but conservative estimate. Now, compare that projected pot size to the amounts that we discussed. Remember, retiring at 55 needs roughly £780,000 for a £30,000 annual income. At 60, you need £630,000 for the same lifestyle and security. And waiting till 66, well, that drops it to approximately £450,000. So, big difference. And there's a gap between your projection and target. Don't start to panic immediately. You have hopefully got time to increase your contributions and catch up significantly. And one way to do that is to make sure that you're maximizing the contributions that your employer is willing to make into your pension scheme. Because again, in my experience, a lot of people missing out on this free money. Because even small increases now compound massively over the next 10, even 20 years' time. And if you do want to do some proper planning, consider working with a financial advisor. They can help you map out how your income can be taken. They can model different strategies, look at scenarios, and help you find that sweet spot for your retirement. And they'll also help you understand drawdown versus taking annuity. What's actually the best option for you in terms of how you take your pension. And of course, check when your state pension is and what you are forecasted to receive. And if you have got gaps in your state pension, you can fill in those by making additional national insurance contributions. Because voluntary contributions might boost your state pension rate significantly for a relatively small cost. So, as a summary, let's just recap the key numbers that you need to remember. Retiring at 55 needs around £780,000 for a £30,000 annual income, and that's going to fund 11 years before your state pension kicks in, plus your remaining years up to we've estimated 85. Waiting until 60 drops that to roughly £630,000 in total, and you're bridging just 6 years, which makes it far more achievable for a lot of people. And retiring at 66 only needs about £450,000 because you're going to get your state pension from day one, and your private pot only needs to top that up to £30,000 if that's what you agree the number is for you. And the tax-free cash strategy matters more than most people initially think. Taking it gradually beats grabbing the full 25% lump sum in one go the moment you retire, because you get more total tax-free money and better long-term growth. And of course, your personal situation determines which age works best for you ultimately, because health, job satisfaction and lifestyle goals all matter beyond than just looking at the numbers. But understanding the real cost helps you make an informed choice. The difference between retiring at 55 and 60 is about £330,000 in terms of the pension pot that you need. Clearly, that's not a small gap that you can ignore when you want to plan. And every 5 years that you work reduces that pot size significantly. So start planning now, regardless of your current age or pension size, because even small increases in your pension contributions can make a massive difference over time, and that's because of compounding, which is effectively the time those contributions are going to stay invested. And check those national insurance gaps to make sure that you are maximising what you're entitled to receive from the state pension. So I hope you found this video helpful. If you did, please do give the video a like and do subscribe to our channel, where we've got lots of content related to retirement planning and the retirement journey that you may be going on.